Good morning, my dear future chartered accountants. I hope everybody is doing great. Can you please confirm first that my voice is audible and the PPT is visible? Yes, thank you. Continuing with our crash course, we have done with the discussion on financial management. Now let us go for the 40 mark section, economics for finance. This will be full of theories, though concepts, so it might be difficult for you to concentrate. I request you to give your utmost focus concentration as much as possible to the extent you can. So first chapter we have is on national income. You would have come across lot of news recently, at least, regarding this discussion on how India is the fastest growing country in the world. When the corona hit, now many people started telling India is in recession, India's GDP has gone down, India's production has gone down. And some people says among developing economies India becomes a superpower, even surpassing China. You would have come across a lot of news like this. So how to value, how to calculate, how to measure the prosperity of a country, that is national income. So what is national income? It is like income of household. Income of household, we tell salary. So what is the income of the entire nation put together? That is national income. It is money value of final goods and services produced by the residents, normal residents in a year. So national income is not the wealth. It is not the asset possessed by India. It is the income, or it's called as flow concept. It is for a particular area, how much is the value of goods and services produced by the company, produced by the country, put together, it's called as national income. And remember, it is final goods and services, which means we don't consider intermediate goods. We consider only final goods, consumer goods, as well as producer goods. Consumer goods, toothpaste, electricity, consumer elements, all those things. Producer goods, laptop, because it is not one time, it is more than once, or even machinery for that matter, equipments, they are called as durable goods or producer goods, basically long term goods, assets, long term, that production. It's expressed in money terms and no intermediate goods. For example, a typical example we give, if you produce cheese, you use milk, or you produce paneer, you use milk. So you don't use paneer also, you don't use milk also. If I do it, duplication will be there. So value of paneer includes the value of milk, and so on. And no second hand. So if you purchase a car and you sell a car, and second hand car, that means you're not produced during the year, right? It was taken into consideration when it was produced originally. So if you produce once more, again if you include, that will amount to duplication. So that will not be included. Second hand car is not included. Transfer payments will not be considered. What is payments? Like pension. Like if you get pension, what service you have done? Nothing, right? You receive the money without any consideration. Transfer payments, donation. Even in US, we have concept of unemployment allowance. If you're not employed, if you don't have a job, you can file a claim with the government. Government will pay you minimum amount. Such system is not there in India. I wish it comes. But of course, in India, we have a different challenge to solve. And also, that's a very one important data. It's called as jobless claim data in US. It will have a very big impact in Indian stock market also. Jobless claims. How many people have applied for jobless claims? That means those people are getting the money from the government for having no job. So they are not producing anything. They are not contributing anything. That is why those payments will not be considered in national income. Even security sales, if you sell land, if you sell property, that is ownership transfer from one person to other person, that's all, right? It is not really any gain being created, it is not being product being produced. If you construct a house, yes, an asset being created, an income being generated, the goods are being generated. But if you sell a house, that becomes second hand, right? That is existing house you sell, that will not be creation of any product. Existing product, it is moved from one hand to another hand. Those things are not called, not part of national income. No pure exchange transactions. I just told you. Now, concept of domestic versus national. So this sounds very similar, but difference is there. National refers to the concept of nation. Domestic refers to physical territory. Domestic territory, we use the word domestic. Political boundaries, India, Bangladesh, borders are there. But foreign SMCs are excluded. So if you have a US embassy in India, though they are physically in India, we consider as if they are part of US only. So in the Indian territory, the US embassies, foreign embassies are excluded for the purpose of domestic definition. So domestic territory is defined on geography, defined based on place. Whereas national income means based on person, Indian person. So if Indian person goes to US, gets some, provides some service, come back to India. So it is not domestic service because he is not in India. He has went outside India physically, geographically, place wise. It is not in India. That is not part of domestic income. But that will be part of national income because that person is belonging to Indian person. So person based. Even foreigners income is also, when foreigners income is excluded, person based is national income. So for the domestic income, if I add NFIA, net factor income from abroad, because just like we go to outside work, foreigners also come to India, basically like export import. Therefore, you do net amount. Some outflow, some inflow, net amount. If I add to the domestic, I will get national. Domestic plus net factor income from abroad is national income. We are going to understand how these calculations are being done. But some limitations are also there in national income. Many people give the opinion it is not a measure of welfare. Just because India's GDP is growing does not mean India is growing. Because when I say GDP, national income of India, it includes everybody's income. It includes your income also, my income also, Mukesh Ambani income also. So when Mukesh Ambani is growing, his wealth is high, it looks like GDP is growing. But in the reality, there are a lot of differences among ourselves. So just because GDP is growing, the income of a nation is growing, does not mean the people are becoming prosperous. It is just like telling, just because your marks card is good, does not mean you are a brilliant person. Just because you score marks, will it reflect its cultural activities? Will it reflect the sports activities or any other potential you have? Art form, how much story you can write. Of course, in exam also sometimes you write stories, that is your art by itself. So the marks will not reflect the holistic view of a person. Just like that, GDP will not reflect the holistic view of the entire country. But we don't have a better choice, we don't have a better measure. So GDP is the only closest measure we have to reflect the growth of a country, prosperity of the country. But limitations also there. It will not be a true picture of the entire nation. The India is growing, rich people are growing, slums are also growing. That is what many people have the opinion. Economic bads. So when I say national income, it include every income, good income also, bad income also. So if you do crime, if you murder somebody and you get income, imagine it will come in cash, but let's say you get the amount in bank. So you show income, you can pay income tax also. That is not reflected in national income. National income considers every income put together. That's why we believe we respect the people based on the money they have, the richness they have. It does not consider the qualitative aspects, economic bats, crime, every evils. All types of incomes are part of it. It does not do any differentiation. Even black money income may also get circulated. What is black money? People don't pay tax, but they use that money to purchase the gold, to purchase the assets. So when you purchase the assets or when you construct the assets, that is part of the goods and services produced by the country. That will be part of national income. So crime income is also part of national income indirectly. Even black money, which is in circulation, when it is used for producing goods and services, will also be part of national income. So they are called as economic bats. Volunteer work and services is ignored. So many places you find out there are floods, earthquakes, corona situation. Lot of people come and work freely, voluntarily. Like you have organizations like RSS. We have many other organizations also who voluntarily work. They don't get any money, professional fees, salary like that. We see a lot of volunteer also. Many doctors volunteers themselves and they'll do free health checkups. A lot of times people go to the slums and teach freely for poor kids. So those kind of voluntary services where money measurement will not take place will not be part of national income. Inadequacy of data, it's a special problem that India has to address, because India is one country but many world, or one world many country, however you want to call it, unity diversity. We have so much of diversity, and India is predominantly unorganized sector. I'm not telling bad, it is unorganized, meaning everybody don't go to bank and take loan. We have a system of taking loan from individuals. We have pawnbrokers where everything is not organized but transaction takes place. Everybody is not under GST. So there are no accounting, there are no trail of events which considers, tracks all transactions, all purchases and sales. So we have inadequacy of data. Production for self-consumption, that is an interesting one. See, for example, a CA provides accounting service, you charge data for somebody else. But you file your own income tax returns, you don't charge yourself. So self-consumption value will not be reported. Even a farmer who produces rice, he also consumes the rice for self-purpose, home purpose. He will eat for living purpose. That will not be included in any goods and services because he will not sell it outside. So self-consumption values are not part of gross national income. So these are the limitations we have in national income. There are many. To name a few, I have mentioned here. Uh, as I told you, this economics for finance is lot of theory and lot of sentences, paragraphs, headings you have to read. So I try to simplify your life by making it into charts. The charts like this, I'm sure it must be there in your material also. Is it there in your material? Not sure whether you have it. Yes? Okay. Yes. So these charts are created by myself, not anybody else. That's why the formatting is not so good. I myself extracted from the study material only. I have not taken any textbook for the base. So this chart is a summary part of your study material. So day before exam, this will be very useful, provided of course you have practiced earlier. Day before exam, you open this chart, you don't understand anything. So when you read this chart, by chance if you don't understand anything, go back to study material and read the respective paragraph. You will find the explanation for this. I've used the keywords here so that you can revise many times and write these keywords in exams. In case you are not able to understand any context, you can immediately refer study material. The same explanation, you will find it there. So please make use of it. Please practice it on day before exam. This will help you revise in a quick and efficient manner. Net factor income from abroad, I already explained to you. It is based on the person basis. Income received by normal resident from rest of the world, from going outside the world. Similarly, rest of the world people, outside people will come to India. So income paid for services within the country. That is what is national net income, net factor income from abroad. So for domestic, if I add net factor income abroad, I get national product. Okay, so we have various types of national income. We have domestic product versus national product. I just told you. So I'm going to summarize now. Domestic product, which is based on geography. If I add NFIA, net impact factor income from abroad, I get national product. NP stands for national product. Then we have the concept of market price. What is the market price? For the factor cost, land, labor, capital are called as factor. For the factor cost, I add indirect tax, GST. Everywhere people say plus GST, right? Maybe when you get marks in exam also, they should tell you plus GST. Passing marks 200 plus GST. You scored how much? 60 plus GST. Everywhere you have to add plus GST. So factor cost plus GST, that is IDT, that is going to give you market price. But sometimes government give you subsidy. They'll give you subsidy in petrol, LPG gas. Of course, subsidy now has been reduced drastically, but they do provide some sort of support, subsidy. So the consumer will be benefited. They will get the product at a cheaper price. So market price is the factor cost, the actual cost of the product plus the GST, indirect taxes, ADT, indirect taxes minus subsidy what government is offering. Net amount is called as market price, what is available to the consumers. And also a concept of net, which is gross minus depreciation. Okay, so we have so many formulas, permutations, combinations possible. So I would like to present you one place all different formulas, because you know gross concept, net concept, national concept, domestic concept, we have market price concept, factor price concept. So many concepts are there. So I would like to summarize this. This you need to write down, but I'll give you time to write down, don't worry. Then you can make a note of it, okay? First I'll give you explanation, then I'll give you time. GDP at market price. GDP at market price. From the market price, I will subtract net IDT. I'll remove the tax element. I'll remove the GST, indirect tax, and subsidy, the net amount. That will give me factor cost. From the factor cost, I take out depreciation. What do I get? I get net domestic product at factor cost. Then from GDP at market price, if I take out depreciation, GDP at market price, that G becomes N, gross becomes net, net domestic product at market price. Correct? And for all of these things, you add NFIA, GDP becomes GNP, domestic product becomes national products. NDP, you add net factor income becomes NNP. Net domestic becomes net national. For GDP at factor cost, it becomes GNP at factor cost. For NDP at market price, you add NFIA, you get NNP at market price. So understand how this is being structured, how to write it in one place. You will get all the formulas easy for you to revise and calculate in examination. I'll explain once more quickly, then I'll give you time to write down. You start from GDP at market price. I subtract net IDT, I get factor cost. I subtract depreciation, I get net of depreciation. Similarly, right side also, I subtract depreciation, I get NDP at market price. For all these things, I add NFIA, all these domestic products will become national products. And we have three methods also. We are going to learn those three methods. Quickly, I'll tell you the revision. I'll again repeat later. When you follow value added method, I'll go with market price. I get the answer at market price. If I go with income method, I'll get it at NDP. And if I do it at expenditure method also, then also I'll get it at market price. So you can write down this part quickly, understand and write. If you have any doubts, let me know. This will be very useful even in solving the problem. So please make a note of this. Once it is done, let me know. Okay. One typing mistake I've done. Now. Okay, I'll correct it. You get NNP at factor cost, right? Yes. First case. NDP at factor cost. I get this at factor cost. Yes, I'll make a change. This NDP at factor cost. When I add NFIA, I'll get NNP at factor cost. I don't get market price. So this will be at factor cost. So please change it. I'll also change it. This, do we get problems in exams? Yes, you do have some problems. We are also going to solve some problems. Once I explain you the methods of these calculations. We will do the problems also to get these things. You do get problems in exam. Yes. Okay. I hope it is done. I'll go further. Okay. Some other terms to understand in this chapter: per capita income, that is income from person. It's like average. In statistics and all, you would have learned. How do you calculate average? Like average marks, sum of all the subjects marks divided by number of subjects. Like that. What is the average income per person? Numerator is going to be total income of the country, GDP, divided by population, number of people, will give you the average income per person. Of course, this is may not be a very good measure of reflecting the prosperity. As I told you earlier, everybody income is added, even Mukesh Ambani income is added, crores of rupees, thousands of crores of rupees, and some other persons having 20, 30 rupees, but divided by same number of people. So this may not be a true reflection of companies, of individuals' income, but we don't have a better measure. Personal income, that is net income, whatever the national income we have or the net income for individual, received but not earned is added, earned but not received is subtracted. So basically cash element, you received but you have not earned it. So your cash is there, that is available for your payments and all, you receiving, earned earlier or going to be earned later, but you receive the money now. Earned but not received, this is like invoice raised but you're not received yet, outstanding debtors. So those things you are going to subtract. So basically this personal income is like how much is cash available. Income received, received in cash, you add it. Not yet received, you subtract it. Effectively cash basis. Disposable income, the PI, personal income minus personal tax. Net income, because individuals have to pay tax. So what is available for you after tax? Surplus. That is called as disposable income. National income at current prices, and we have national income at constant prices. This is to reflect the inflation impact. So what do you understand this current price and constant price? I'll just give an example. Suppose in 2020, let's say you produce 1000 units, okay, and it is at 20 rupees, or let's say 10 rupees. So you get 10,000 rupees as the GDP. Next year, 2021, you produce 1000 units, let's say you produce 1200 units at 11 rupees. So you get 1200 into 11, 13,200 GDP. Now if you observe, what is the actual growth of this GDP? If you see from 10,000 to 13,200, what is the growth? It is 3,200 divided by 10,000. So it looks like some, how much percentage? 13,200 minus 10,000 divided by 10,000 into 100. Percentage terms. 32% is it, right? It looks like GDP is growing by 32%. But actually, is your country really going up by 32%? Has your activity level increased by 32%? No. Your activity is 1000 units, becoming 1200 units. So 1000 to 1200 units, your actual is 20% only, right? 200 by 1000, 20%. Then what is this 12%? That extra impact, that is going to be inflation. That means instead of doing at 13,200 GDP, what we do, I would like to calculate the price of the old. So I will take 1200 units, but I'll take the price of not 2021, I'll take the price of 2020, and 2020 the price was 10 rupees. That becomes 12,000. Now you see the growth, 10,000 to 12,000, 2,000 by 10,000 into 100, you get 20%. So this reflects a true picture. So this value of GDP using today market price is called as GDP national income at current price, and use this, or you take the volume of the current but price you take the old one, and that is GDP at constant price, the price remaining same, so that you can really understand the volume impact. In other words, the GDP at current price adjusted for inflation, that is what you get at constant price. You remember in financial management we discussed real versus nominal. Real rate of return with inflation together is nominal rate, correct? So GDP at current price is like a nominal value, it includes inflation. If I subtract inflation impact, that is a constant price, and that is your real price, or constant price. So with inflation, a national income at current price, without inflation, purely focusing on volume, that is national income at constant price. Some terms that you have to keep it in mind. Will you repeat? I'm not sure from where I have to repeat. It just means that national income at current price is a today price. At constant price means I don't want today price, I will be taking the old price. That is what the meaning of constant price means. If you take the 2020 to 2021, when I calculate 2021 with 2021 price only, that is at current price. But if I take the price of 2020, that is old price, if I take it without inflation, if I take it, that is called as constant price. Hope that is fine. I'll go further. Okay. Methods of measuring national income. We have three methods. Value added methods. That is, we take the different goods and services what is produced by the country. Factories are there, godowns are there, service organizations like law office, doctor office, CA office. So all the goods, value, services are added. So where does the government gets the data on goods? I am taking the class here and I get paid for it. How does government come to know about it that I am taking class? I have provided you a service. It's all through, we have a system, of course. We have a system of accounts in India. But more importantly, it is not ITR. ITR we report only income. We are reporting only profits. But this is not profit method. This is value added method, goods method, services method. That will be one way ITR, but more importantly from GST. GST will have all the goods and produced goods and service produced. But anyway, many methods are there. ITR is one of the method. GST returns are another methods. Many other accounting system is there within the organization. So value of final goods and services produced or net value added. Only final goods, intermediate goods are not considered. We are going to divide based on industry wise. I'm going to show you that. It will be resulting in GDP at market price. Income method also we have, where various factors of income, we call factors of production in economics as land, labor, capital. These are the main factors required for a business or for an entity. So all those income, rental income, salary income, surplus, interest, everything is added. Profit plus dividend plus interest plus salary, and this will give you NDP at factor cost. Why NDP? Why net? Because income will not have depreciation element. So it will be not at gross, it will be not at gross, it will be at net. Expenditure method, one person's income is other person's expenditure. So if you purchase a toothpaste, for you it's an expense. For the toothpaste company, it is sales, it is income. So we can also go by expenditure method. One person's expense, other person's income. So consumption expenditure, that is C, plus investment expenditure C. Even government expenditure, government also spend money on roads, flyovers, metro and so on. And X minus M, net export, export minus import, that will also give you national income. It will be resulting in again GDP at market price. Anyway, when you do the problem, you'll understand better. Let me go little bit in detail now against each method. Value added methods. Hope you understood the overall. Now I'm going to go one by one. Okay, let's take up one by one. Value added methods. Value of final goods and services produced by the country, or also called as net value added. We are going to do industry wise. What industry? Primary industry, using natural resource, agriculture, fishing, primary industry, forestry. Secondary industry, that is using raw material of the primary, using sugar cane, sugar is produced. So sugar manufacturing, rice mills, using the rice grown by the farmers, rice mills will make it into rice and they sell it. And using those rice, hotel industry will make food. So those things are called as secondary industry. Using the raw material of the primary industry, they're producing it. Manufacturing, electricity, all those things. Then we have tertiary sector or service sector, doctor office, CA office, engineer's office, or lawyer office, service organizations, or even IT services. Service organizations, basically intangible, you can't see the service in your own eyes. So those industries, goods and services, goods values, service values are added. So when you get here, you will be getting at, gross you will be getting at. From the gross, you subtract intermediate goods. If you subtract depreciation, you get net. If you don't subtract depreciation, it will be at gross. And if you subtract IDT, net indirect tax, I'll get factor cost. If I don't subtract it, then it will be at market price. Some precautions to be kept in mind. To the extent possible, self-consuming goods are also to be added. It is important, very difficult in practical life because data will not be available. Self-consumption, a lawyer representing himself in the court, a doctor treating himself. So it's very difficult to keep the data, but if somebody provides the data, that also to be added. Own account of production of fixed assets, also like a self-consumption, like a IT company who purchases and sells computers. They also use computers for their own purposes. Furniture dealer who buys furniture, sells furniture. He will use furniture for the customer to sit. It will be used within the organizations also. So those things also to be considered. Even residential building. Imputed rent of owner occupied, again difficult to track the data but ideal to consider. So if you are occupying somebody else's house, you pay rent. Rent is a part of service being created. But if you are in your own house, you don't pay rent to your house, but that is also value of goods which is produced by the country, services produced by the country. From a country point of view, even you occupying yourself also would like to be part of the income produced. You mean captive consumption? Yes, captive consumption is very difficult to track practically. Data will not be available, and it will not be easily obtained. Nobody keeps the data, but theoretically, thinking theory wise, we would like to consider. One small example I'll give you. You will understand how this captive consumption can play a different role in GDP. One simple example I give. Okay, you are in, let's say, Bangalore. Okay, now Mr. B is, let's say, in Chennai. Okay, this is your place. But Mr. A, let's say, has to relocate to Chennai. So he will be in B building. He pay rent of, let's say, 1 lakh. Now B is relocating to Bangalore for work and he pays rent of 1 lakh. Now what will be the GDP of a country if we consider only these two cases? A's income 1 lakh or A's expense 1 lakh, goods and services provided. B's goods and services rental income 1 lakh. So total GDP 2 lakh. But if you stay in your own house, A is in Bangalore only, B is in Chennai only, then nobody pays anything. That means you make it as 0, 0. You understand? But if I consider captive consumption, imputed cost, opportunity cost, though it is A is having his own building, if you consider imputed cost, the value of the property in income, that means this value is 1 lakh, and here his value is 1 lakh, and there you tell total is 2 lakh. I hope you understand the impact of this imputed income, opportunity cost, or self-consumption. You can call whatever name. So it's very difficult in practical life to consider these things, but ideally, theoretically, we will recommend to include. This is the value added method. Just go to the chart once quickly. Okay, let's go further. Income method. So income method, various people incomes are added. What various income? Labor, wages, salary, compensation to employees, current wage, employers' contribution to social security schemes, gratuity, PF, contribution towards PF, contribution towards superannuation fund, ESI, insurance, everything. That is all contribution made by the employer for the benefit of employees. Compensation to employees. Old age pensions are not added. If you remember, I told you transfer payments. So once employee retires, if he gets pension, those income is not added because that will not involve any services from that person. When he was in service, he was paid salary, that is already considered. Now, when he gets pension, he is not contributing anything back, transfer payments, so they are not part of national income. Old age pensions are not considered. Another factors of production, capital, property income, rental income, operating surplus. So when you prepare P&L account, you understand the surplus money, remaining money, operating surplus. Sales minus expenses minus depreciation minus tax, surplus amounts. Interest income, earned by person, or even dividend. Dividend also be part of operating surplus. Interest on government debt is not added. Interest accrued is also considered. Interest on government debt, because government debt means what? Treasury bills, government bonds, those interests are not considered. Royalty, dividend, undistributed profit, these are all represents income of various persons, therefore considered. Why on government debt is not added? One of the question people can ask, why government debt interest is not added? See, if government, if government prints more money, if government prints more money, do you think income of the country is increasing? Government prints more money, is the income of a country increasing? No, right? Because government printing money is not a product, is not a service. Therefore, similarly, when government pays interest, it is government debt. It is government's cost, but it's not adding any value as such anywhere. If government spends money for construction of roads, for which they pay towards materials, yes, a material is being purchased, metal is being produced. But interest in government debt is very similar to printing money. It will not add any value of goods and services, so that is not considered. Okay, then mixed income. Some government providing grant is added. Again, just a grant as such is not added, that will amount to subsidy. But if it is towards some services, then we will consider it. If it is any goods are produced, if goods are purchased, then those things are considered. Otherwise, grants are not, just a grants are not considered. They are amounting to subsidies. Okay, mixed income. Who will have mixed income? Typical CA office. Because CA office, we own the organization. I'm as a proprietor, let's say, and I don't pay salary to myself. So income what I'm getting from my office is my business also. I'm a proprietor, I'm an owner. I get the income like a businessman. I'm also working in the business. So it is a mixture of my business income as well as my salary income, my professional income. They are called as mixed income. That is also considered. The result what you get is net domestic product at factor cost. PGBP income, I can't really just say PGBP income. No, that is not the point, my dear friend. When you do business, when you also work, that's not point. You have a business, you get a business income, you invested in partnership, you have a CA office, you don't run, you are just sitting at home, you get income. Why are you getting income? Because you invested for the capital what you are getting, that is profit. But if you also work, so you are putting your efforts, you are putting your time for that. Are you getting separate income? You will get, in case of partnership firm, you have something called as partner salary. You understand? Partner gets two types of income. Partner salary will come as well as partner's share of profit will come. But if it is your own organization, that distinction will not be there. That's why it's called as mixed income. Hope you understand. Again, same precautions: imputed rent, imputed salary to be considered. Self-consumption items would be have to be included. Same precautions, nothing much different. Only point is when you follow income method, you will be getting an NDP. You will not get GDP. In the earlier method, value added method, or in the expenditure method, which we are going to do, you get it at GDP, means including depreciation. But when I do income method, income of various individuals, income of companies, income of property, it does not include depreciation, so it is resulting in NDP, net domestic product. Okay, just go to the chart quickly. Okay, let's go further. Expenditure method, as the name itself says, expense made by various companies or various individuals, and consumption by household, that stands for C, and consumption by government also. Government also spends money on infrastructure. They pay salaries to employees. They pay salary to police department. They have to maintain military department. Right? Government has to pay salary to their employees, their MPs, their politicians, non-performing asset basically. Anyway, investment, investment in the firm, or investment by the firm, or investment by the government in machineries, in durable products, government investments, everything, government purchasing machineries, government purchasing buildings, those things. Foreign components, net exports, exports minus imports. And when you add all the expenditure of these kinds, you will get it at market price. Uh, National income at market price. Even value add method also we got market price. But only in income method we will get it at net product. This will be at gross. So again here also we will divide into two kinds of sectors, mainly household, then government, and then net exports. Household, we will have a private final consumption and even non-profit investment institutions, all kinds of private. For example, if some schools, non-private institutions, they spend money, that is also be part of consumption plus investment. Business, investments, fixed asset purchase, stock purchase, increase in stock, residential houses, they're all called as investments. Government spending money, government expenditure. Government also spends two things, current expenditure and capital expenditure. Both are considered here. Current expenditure, government, like salary they have to pay, I told you, salary for MPs and all. And capital expenditure, like purchase of building, purchase of computers, those kind of thing. Final consumption, current as well as capital. Charges collected, if any. So when you, if they collect any charges, then that will be subtracted, net expense. Foreign element, that is net exports, exports minus imports. Result in this method, you will get GDP at market price. So go through this chart also quickly. Okay, I'll go further. Okay, you should have some problems in the material. Let's do take some problems. Okay, so come to this problem number one. Calculate the net national product at factor cost. Before read the data, first try to take it to your head what I need. Net national product at factor cost. Net product. Net means what? We should not have depreciation. National products. What do you mean by national product? From the domestic, I need to add NFIA. And factor cost. Factor cost means I should not have subsidies. I should not have indirect tax. From the uh, market price, if I subtract net indirect tax, I will get factor cost. So requirement, keep it very clear in your mind. Now let's see what is available. Value of output in primary sector, secondary sector, tertiary sector. Intermediate consumption we don't consider. We should eliminate it basically. Primary, secondary, tertiary. Net factor income from abroad, net indirect taxes, depreciation. Then we have to calculate the national income. Okay, so what and all we are going to do? Value of output we consider primary sector, tertiary, secondary sector, tertiary sector. Then we subtract intermediate goods. So minus 50, minus 60, minus 60. Net income from abroad. This should be added, but minus 50. So subtract it. Then what should I do with respect to net indirect tax? Now when I do at this stage, I will get market price. I subtract net indirect tax, I will get it at factor cost. I again subtract depreciation, I will get it at net one. So let me just show it to you. So at this stage, if I do this one when I do, or yeah, this will be GDP at market price. And when I consider net income from abroad, that will be GNP at market price. And when I subtract this indirect taxes from the market price, I will go to the uh, national products. I'll go to the factor cost from the market price. I go to the factor cost, and when I subtract depreciation, there is what I get: net national product at factor cost, and that's what requires. That is equal to 520. So write it. Okay. Any doubts here? Shall I go further to the next question? Okay, next. Calculate gross domestic product at market price. Gross domestic product, domestic net factor income from abroad will not come. At market price means we don't worry about subtracting indirect tax, that is the subsidy, and derive national income from the following data. Okay, so what we have: inventory investment, exports, indirect taxes, net factor income from abroad, personal consumption expenditure, gross residential construction investment, depreciation, imports, government purchases of goods and services, gross public investment, gross business fixed investment, like fixed assets. So you know the format. This is going to be the method, expenditure method. So consumption plus investment plus government plus export minus import. This is what is going to give you GDP at market price. So let's do this parts. Personal consumption expenditure, all part of C. Gross investment, that is business investment also will take it. Residential construction investment also will take it. Public investment also will take. These are all part of I. Inventory investment also. Government purchasing goods and services, this will be government. This is G. So this is basically C. This is investment, all types of investment, and this is G. Then exports, net exports, exports minus imports, exports 200, imports 100, that is export minus imports. So GDP at market price 5,500. Write down until here. Okay. So hope you have done till here. Okay. Still doing? No problem. First line not seen. First line, it just has personal consumption expenditure. That's all. Okay. Hope it is done. Okay. Next. One more thing they've asked, that is, and also derive national income. When I say just national income, what needs to be computed? Practically, there is no consensus. Different people have different opinion. But as far as the examination is concerned, from exam point of view, if they just tell you national income, it is net national product at factor cost. You have to adjust for depreciation, adjust for net factor income from abroad, and you have to adjust for net indirect taxes. These three things you have to adjust. So we have indirect taxes should be subtracted, net factor income abroad to be adjusted, depreciation to be subtracted. So these three things will convert from gross to net. We subtract depreciation. From domestic to national, we consider net factor income from abroad. And from market price to factor cost, we will subtract net indirect taxes. So net factor income abroad, I subtract, I get GNP at market price. From the domestic products, I get national product. I subtract indirect taxes at market price, it becomes factor cost. From the gross to the net, I'm going to subtract depreciation. Thereby, I get NNP at factor cost. When we just say national income, we will take NNP at factor cost. Okay, let's go to the next one. Find GDP at market price and GNP at market price from the following data in crores rupees using income method. Show that it is same as obtained by expenditure method. Personal consumption, depreciation, wages, indirect taxes, interest, domestic investment, government expenditure, rental income, corporate profits, exports, net factor income from abroad, mixed income, imports. Okay, so what do we do here? Let us identify what is the expenditure method. What is relevant in expenditure method? Remaining elements are for income method. Balancing figure approach, easy to apply. Let's identify. You know what is expenditure method? We will have C plus I plus G plus export minus imports. These are the components of expenditure method. So let us identify expenditure method, remaining are all income method. Now personal consumption, that is expenditure method. Depreciation, I will not consider. Wages, I will not consider. Indirect business taxes, I will not consider. Interest, that will not consider. I mean, I stands for investment. Huh? Domestic investment, yes, this is I. Government expenditure, yes, that is G. Rental income, no. Corporate profits, no. Exports, yes. Exports, X. Net factor income abroad, no. Mixed income, no. Imports, yes, I. That is X minus M, sorry, M. So C we have, I we have, G we have, C available, I available, G available, X available, M available. Remaining elements will be part of income methods. So let's calculate. So what and all will be income method? We'll consider wages, we'll consider interest, rental income, corporate profits, mixed income, and we adjust. We want to get market price. So and we want gross. Oh, depreciation we don't really require, but we have to add depreciation because when you follow income method, I will get without depreciation. Remember, I repeat this point. When you follow income method, I will get it at net. Depreciation will not be there, but I want gross. I want GDP. I want GNP. I want gross. So from the income method, I need to add depreciation. So that will give me the gross. And I'll have to adjust for net factor income from abroad. From the domestic, I'll get national. And I'll adjust for indirect taxes. From the factor cost, I'll be able to go to the market price. Let me show the solution. I'll give you time to write down. First, listen. Income method, wages, rental income, interest, mixed income, corporate profits. So this will give me basically net domestic income at factor cost. Now I'm going to adjust. I need market price. So taxes being added and I want gross. So depreciation is added. I'll get GDP at market price. And if I add net factor income from abroad, from the domestic, I will go to the uh, GNP. From the domestic, I'll go to the national products. So first you write down income method. If you have any doubts, let me know. Then I'll do the expenditure method. Okay, so let's do the income method now. Sorry, expenditure method now. Consumption C, investment I, government expenditure G, exports minus import X minus M. This will give you same number 10,890, that is GDP at market price. And you can add a net factor income from abroad, you will get same GNP at market price. So take down expenditure method. Okay, shall I further? Indirect business tax is same as net indirect tax. Indirect business tax is same as indirect tax. We don't have subsidy information, so this also becomes net. So indirect business tax is same as indirect tax. Because no subsidy, subsidy is zero, so this also becomes net IDT. Okay, hope it is done. I'll go further. Okay, this is the last problem. So can you please try it? I'll just give you 5 minutes. Can you please try this one? From the following data, calculate net national income at factor cost, means national income, by income method as well as expenditure method. So please try both the methods, and it's like a balance sheet getting tally. You should get the same answer. So please try it. How much you're getting? Okay, GDP at market price, but we need net national income at factor cost. They are asking only one thing. Okay, I'll put up the solution. If you have done, check it out. You should get under both the methods 1850. So please check out your answer and correct your answer. If you've gone wrong or if you have any doubts, you can let me know. Is it completed? Any questions? If you're still writing, you can take a screenshot of this quickly. You can copy it down later. You can take a photo of this. In expenditure method, why we haven't considered depreciation? Because it will indirectly be considered already. See, for example, when you say in expenditure method, uh, private expenditure or domestic capital formation, you purchase fixed assets. So the amount of depreciation of machinery used to produce fixed assets, to produce computers, laptops, would have been already considered. So depreciation is not considered separately in expenditure method. It's already part of it. Similarly, even in value add method also, I don't add depreciation. Value of products includes the value of depreciation. Okay, so hope that is fine. So please take a screenshot, photo or something. If some of you are still writing it down, you can copy it down later. If we take it, will it be wrong? Yes, it will be wrong. Absolutely right. Absolutely wrong. Depreciation, you cannot do it again. It will be double. When I say value of product, expenditure wise or value added method wise, depreciation is already included. So we should not take it once more. That's why we'll get GDP at market price. When I subtract depreciation, then I'll get the NDP. From gross, I'll go to net. So depreciation is always part of it. Okay, so hope this is done. That completes this chapter. Let's do one thing. Let's take a quick break of about 15 minutes. Then we'll go further. So 11:30 now, 11:28, 11:30. Let's meet at 11:45 and we'll take up the next part. So take a break of 15 minutes. 11:45 we'll meet.